It's Wednesday, August 19th, and the Treasury has announced that they are going to double debt buybacks in order to cap the long end of the interest rate curve. So interest rates fell sharply today. The 10-year yield fell, the 30-year fell 1.6%. And on the other hand, gold soared 3% on the news. Bitcoin is up 5.5%. Gold is now at $4,500 rather, and Bitcoin is now at 68,000, approaching 70,000. The S&P and the Nasdaq are both up. So it's a risk-on day today as yields fall. Adrian Day, president of Adrian Day Asset Management and portfolio manager of the Euro-Pacific Gold Fund, is back with us to talk about what this means for markets and what's ahead for the Fed. Welcome back to the show, Adrian. Good to see you.
Well, thank you for having me, David. Good to see you.
Let me just read to you a paragraph of what the Treasury has decided to do. The Treasury Department on Wednesday said it will more than double the size of its government debt repurchases, sending yields sharply lower at a time of substantial market stress, with fixed income markets under pressure and yields surging to levels not seen in nearly 20 years. The announcement targets a sensitive long-duration part of the Treasury market. When have we seen this before, Adrian?
I'm sorry, say that again. When have we seen it before?
Yes, when have we seen this before? This sounds like deja vu.
Yeah, this is Operation Twist, of course, and trying to push down the long end and increase the short end. Now, we haven't talked too much about increasing the short end. They don't want to talk about that. But even if the short end stays flat, pushing down the long end, to try to control the yield curve. I mean, yes. Clearly the Treasury was very, very concerned, increasingly concerned about the lack of real buyers at the long end. And even though the amount of issuance at the long end has declined, so the supply is down, the demand is down even more. And of course, this is why we had that intervention in the yen. Time flies, doesn't it? Was that last week or the week before?
That was July 31st. Time flies indeed. It's almost been 3 weeks.
Like every day it's a new world. Yeah, so that's why we had the yen intervention to try to stop, or in an attempt to stop stop the Japanese government selling more of their bonds. Now, the Japanese holdings of bonds have gone down anyway, as we know. But I mean, it's all part of that, I think. It's all part of a concern about how are we going to sell long-term bonds and who's going to buy them.
Let's back up. Why is the Treasury concerned about why or where the long-term bond yield is heading, and why they're concerned about the fact that the 10-year and the 30-year, the 30-year in particular, has been above 5% for more than a month and a half?
Yeah. Well, look, David, first of all, as I've said to you before, I don't pretend to be a credit or bond specialist. But I mean, clearly, if the bond market is weak, and evidence of that would be yields moving up, that just makes it so much more difficult for them to sell those bonds. Even though the yield is higher, we know just from empirical evidence that higher yields don't always attract more buyers, because higher yields are, other things being equal, a reflection of weakness in the underlying market, the underlying currency, the underlying economy. That's why Brazilian bonds are not the top performers this past year, despite high yields. So, I mean, I think the fundamental concern is selling bonds. And if the yield moves too high, that means the bonds are going down. That is a reflection of weakness in that market. And we've already seen for the last few years, we've seen increasingly, difficulty. We haven't had any failed auctions, but we've had fewer and fewer people willing to buy the 20 and 30 year as an investment. People say, the foreign participation has gone up, but I mean, a lot of that is the Cayman Islands, which are hedge funds buying for trades. It's not the buyers we want in treasuries, long-term, people who are going to buy it and hold it for 30 years, which is primarily pension funds and insurance companies, primarily in the US, and in foreign governments and foreign institutions. Those are the people who are going to buy and hold for 20, 30 years. and they're just not interested.
I want to come back to the Fed and markets and the yields, bond markets, rather, in just a bit. Let's talk about gold first. Jump straight to the point. Are you buying gold on this rally? And by the way, this gold rally that is happening today is not the first time that gold has been moving up. Gold has been rallying ever since the end of July, on July 31st. When the U.S. announced an intervention in the yen market, which signaled, by the way, to investors and markets alike that the Federal Reserve and the Treasury, both, specifically the Treasury, was willing to do exactly what we're seeing today, which is to try to cap the long end of the interest rate curve from going up. And higher rates would be bad for gold. So given what's been happening with the bond market in the last 2 weeks, are you more bullish on gold than, let's say, a month ago?
I am certainly much more bullish today than I was 3 or 4 months ago. Okay. That's for sure. Now, over the past 2 months, as you sort of indicated, we have actually seen gold move up. More importantly, silver has moved up. The gold stocks have moved up over that period. And then, of course, gold has moved up all month. And I find these two things very, very significant, David. First of all, the fact that until today, or yesterday, let's say, gold was moving up in the face of a strong dollar, higher yields, and that should not be positive for gold. But in the face of that, and higher oil, sorry. So a strong oil price, a strong dollar, and yields moving, as you said, to 20-year highs, and yet gold was moving up in the face of that. So I think gold was seeing that these moves were indications of fundamental fragility in the system, and maybe they were foretelling some kind of QE or yield curve control or whatever. Those are different things, of course, but they're all monetary easing, which is positive for gold. The second thing, as I mentioned, and this has been for the last month or even more, silver doing as well as gold, depending on when you start it. On some time frames, silver has outperformed gold. The juniors, GDXJ, performing equally with the GDX. So the more speculative markets, both the more speculative metal and the more speculative stocks, are keeping up with the more conservative ones. That's another sign of a very positive market. So both of those two things, frankly, were making me very bullish over the last month or 6 weeks. So you asked me at the beginning, was I buying today? We've been buying so heavily, I don't have an awful lot of money left, to be honest.
Silver is heating up again, and today's sponsor, Brixton Metals, is delivering some extraordinary results. Silver continues to play an increasingly important role in the global economy, driven by both investment demand and growing industrial applications, including electrification, solar, and advanced technologies. With the silver price back above $60 an ounce, high-grade discoveries and drill results are getting harder to ignore. And that's where Brixton Metals' Langus Silver project in Ontario is standing out. Brixton's latest drill results returned an exceptional 20 meters grading 5,015 grams per ton silver, including 0.65 meters grading an extraordinary 89,125 grams per ton. For Brixton, this is about more than one spectacular drill hole. It's about demonstrating that the Langus system continues to deliver exceptional high-grade silver and expanding the opportunity toward a potential resource. With drilling continuing, Langus is quickly becoming a silver story worth watching. For more information, please visit the company's website at brixtonmetals.com. Brixton is trading on the TSXV under the symbol BBB and on the OTCQX under the symbol BBBXF. Do your due diligence today. Wow. Would you be selling, I guess, mining stocks or equities in other sectors to be rotating more into the gold sector?
That's always, yes, in principle, but of course, so much depends on the individual. Again, if you've got a conservative client who started buying gold and gold stocks 3 years ago, with a 20% allocation, which is a reasonably high allocation for a conservative client, and he's now got 35 or 40% in gold, no, I would not be selling my conservative global equities to fund more gold. But certainly, if you had a client who's underweight or an investor who's underweight gold, I think you need to raise cash somewhere to buy gold. You need to be in gold and gold stocks at this point.
Some investors are concerned about this being a dead cat bounce. Certainly, this pattern has been observed before in 2011 into 2012. There have been a series of rallies into newer lows, meaning rallies during a bear market. And of course, hindsight's always 2020. We can say in retrospect, those were false rallies. But how do we know that the story now has shifted and now we have a more fundamentally bullish picture for the precious metals rather than a repeat of what we saw in 2011, which is a series of fake rallies?
No, that's always a fair question. And of course we had, these fake rallies, not so many of them, but we certainly had significant fake rallies after 1980, Tom.
Yeah.
So how do you know that the rally is not a false rally or just a dead cat bounce? I would ask a different question. How do we know that February this year was not the top or a major top in gold a la 2011 or 1980? That to me is a question, because obviously if February this year is the top of this bull market that's been going on since 2015, then everything that follows is going to be a dead cat bounce until we're totally washed out. And so I would answer that question, my question, not your question, by saying that earlier this year, although we had inflows into GDX, although we had physical buying in China, we did not have the kind of mania that we saw in 2011. In 2011, you saw the physical gold ETFs trading at premiums. You had the gold stock ETFs trading at increasing premiums for periods of 4, 5, 6 months, and even trading at 4 and 5% premiums for periods of time. In December, January, February this year, although we had an inflow into the GDX, it was nowhere near that. And it was nowhere near a flood of money coming in. So again, we're seeing in the last week, we've seen huge inflows, a big jump in inflows into the GDX and GDXJ, big inflows. But go back 1 month, 2 months, 3 months, and it's fairly muted. This is not a flood of speculative money pouring into the market. So I don't think it was a top in January. Now, of course, if I'm wrong on that, I'm wrong on whether this is a dead cat bounce. But I don't think it was a top. To me, there was no sign of the public participation and the speculative fervor, but always accompanies a major top in gold.
Do you know, or can we speculate as to whether or not further debt buybacks from the Treasury would accelerate inflation?
They would certainly be inflationary if they are not reduced. They're buying back, but they're not going to reduce issuance at the shorter end. And so the money supply is simply going to continue to move up, which is, in its nature, inflationary. I mean, if they were buying back, you can have a situation where you have a fiscally strong government with a budget surplus or no deficit, but wants to start buying back long treasuries just as corporations buy back debt. That's a sign of health. We are not in that situation right now. We are not buying back because things are healthy. So if they're buying back at the long end, but simply increasing the issuance at the short end, yes, that's definitely inflationary.
You're a precious metals stock investor, so gold stock investor. And like you mentioned earlier, huge rally today on the GDX, 9% rally. Gold stocks right now. If you were to nail down, I guess, other variables that would be pushing around gold stocks besides interest rates and simply the gold price itself, what would those drivers be for gold stocks? In other words, for gold stock investors, what are some of the most important variables and drivers to pay attention to this year?
Well, certainly flows is important. I mean, you have to have flows in order for the stocks to continue to move up. I think the health or otherwise of the US, of the broad stock market is important. Now, as we've seen, both the broad stock market and the gold stocks can move up at the same time and frequently do. But I think one of the signals where you're going to start getting larger flows of retail and generalist money into the gold stock sector will be when the broad market turns over. But I think the fundamentals are also, the longer term fundamentals are just critical. What is happening to fiscal deficits around the world? It's not just the US, of course, but what is happening around the world to debt, government debt in particular, and it's just continuing to increase. And so with increased debt, people are going to look for an asset that can protect them from the ongoing devaluation devaluation of the purchasing power of their own currencies. And it's, as I say, it's not just the US. We're seeing it in Canada. Britain today announced both an increase in unemployment and an increase in inflation. Does that sound familiar? It's the same story in a lot of the developed world. And the deficits are just not, they're not being tackled. They're not under control. And that's positive for gold. We also need to look at, on a monthly basis, we can look at what the central banks are doing and what other big buyers like Tether are doing. So far this year, I think the evidence is there was some selling in March with the war, with the conflict in Iran. But other than that, the evidence so far is that the central banks and Tether are just continuing to buy gold in increasing amounts.
Based on what you've seen in your career, how long does a bull rally have to sustain itself in order for institutional investors or even large retail investors to start to deploy capital into the GDX and the gold miners? In other words, how long do their stocks need to rally before they are convinced they're able to raise money more easily?
You know, that is a brilliant question. If only because it's something I've asked myself many times.
Yes.
All questions are brilliant if they're questions.
Great minds think alike, Adrian.
I'm not going to say this time is different.
Yeah.
But there are differences in this bull market over previous bull markets. And the major difference is that we had gold moving up meaningfully for years before the gold stocks even caught a bid. And even after they caught a bid, until last year, they did not exhibit any leverage. So it really is an unusual bull market, because typically from the day gold bottoms, you can count 2, 3, 4 months before the gold stocks start going up 2, 3, 4-fold over gold. That clearly was not the case this time around. Gold really bottomed, the end of 2015, I guess, and go all the way back then. But increasingly, it's been moving up since 2022. And the gold stocks really only started moving last year. So it's been an unusual circumstance. I'll be honest, I am very surprised that with the gold stocks having 9 consecutive quarters of increasing free cash flow, I am really surprised that more institutional investors have not noticed that and started paying attention. You know, if you look at the gold stocks, as I say, I mean, the free cash flow has just been moving up dramatically, huge margins. Agnico, which is the second largest gold mining company, is perhaps, well, not perhaps, it's the best of the big miners. So I'm picking an example that's favorable to my argument. But 1549 all-in sustaining costs with gold over 4,000, those are incredible and unprecedented margins. And then you look at the valuations of the stock, and on every metric you want to look at, they are closer to their long-term lows than they are certainly to their highs and even to their long-term averages. And so I am surprised, frankly, why more institutional investors have not, and more generalist investors have not started paying attention. I think the answer to that is that the S&P continues to move up. And if you can, if you can make money just holding on to the S&P, that's certainly true for a lot of retail investors who maybe don't pay as much attention as institutional investors.
Yeah.
And the other thing, frankly, David, is, as Oscar Wilde told us, there's people who know the price of everything and the value of nothing. And I do this myself. If I'm looking at a sector that's new for me, and I look at a graph and it's just gone straight up, it's gone up by over 100% in the last year, I'm not so interested. And so I think people are looking at the price and saying, oh, these things can't be cheap. And that's why, frankly, if I can do a tangent, one of my sort of principles when I'm looking at whether it's a new sector, a new market, a new stock, I never look at the price until I finish my research. I always look at the fundamentals, the price to cash flow, the growth in cash flow, the book value, et cetera, and decide, is this a company I want to buy? Mm-hmm. And then I look at the value, then I look at the graph.
I was told yesterday by somebody that some of the bigger miners that have been successful, including Mark Bristol at Barrick, have historically used very conservative gold price targets when calculating the economic feasibility of a project. And today, if you were to be a CEO of a large gold producer and you wanted to be more conservative, what price would you use?
Well, you're right. A lot of the companies as of last year were still doing sub $2,000 prices, which I thought was a rather conservative, to be honest. But remember, if you're a big mining company, so you're looking at a deposit that's 5-6 million ounces, right? That's something of, or let's say 4 million ounces minimum. And you're looking at something that might be going for 20 years. Well, what's happened last week and last month is really not particularly relevant to your decision whether or not you want to go ahead with that project. And remember, when you're doing the economics on a project and you make the decision to move ahead, even for a gold project, it's going to be, 3, 4, 5 years before you're producing. And then you've got another maybe 20 years on a really big project. So you're looking at what price assumption can I make over a quarter of a century? And so they have to be conservative. That's only reasonable. But your question was, what price would I use? I would certainly be using 3,000, which is more than virtually anyone I know of is using.
Basically, then, there's very little chance gold is going to retrace below 3,000 in today's environment. Is the underlying assumption that you should be making, correct?
You would have to assume that from what I just said.
Yeah, it's basically, you don't... If I had to pull your arm and ask you for a scenario in which gold would somehow fall below 3,000 in the next 2 years, what would that world look like, hypothetically?
Well, there'd be a couple of things. One would be that the central banks just decide they're full up. We're full up, we're not buying anymore. That's number one. Number two, there would have to be crises of various types in the world, which means central banks and others would then start to use their gold for liquidity, as we saw in February, on a limited scale. And then the third and the most fundamental thing would be governments around the world would have to get their fiscal houses in order.
Yeah.
Now, there's no sign of that happening. At some point, we will reach a breaking point, at some point will reach a breaking point where, long-term bonds of Britain or Germany or US don't sell. Will reach a point where governments have to postpone repayment of debt. We're not there yet. We're a long way from there. So I think if governments were to get their fiscal houses in order, that would certainly change my mind on the price of gold.
Okay. Finally, before we go, we have 1 minute left. Adrian, BHP, the world's largest miner, has reported its best year ever for copper, for its copper division. BHP, the world's largest mining company, reported booming growth for their year to June as copper overtook iron as its primary profit driver for the first time on an annual basis. The Australian group said profits generated from its copper mines rose by 48% to $18 billion. Now, I know a lot of this has to do with the fact that copper has soared to new all-time highs, but the fact that this has made mainstream news and the fact that copper is, not overhyped, but very much hyped right now in the commodity space. Are you looking at this as a transition into a copper play, this environment right now? Are you perhaps pivoting into base metals?
Well, I wouldn't say a transition right now into copper. The time to transition into copper was probably a year ago. But there's a couple of things to remember. Yes, you're trading at pretty much all-time highs for the copper price. Look at copper versus gold for the last 3 years, and you see a bit of a different picture. Copper has lagged gold for the last 2 years, let's say. So yes, it's at all-time highs, but it certainly hasn't moved as dramatically as gold has. So that's number one. The second point I'd make is that in the middle of a gold bull market, and this is an unusual gold bull market, there's no question about that. I keep repeating that, and it's important we understand. But we had like 3 or 4 years of gold moving up without the gold stocks participating. So it's an unusual cycle. But typically in a gold cycle, in a commodity cycle, I should say, sorry, David, in a commodity cycle, which can be long, commodity cycles tend to be long, gold will lead in the beginning and gold will lead in the blow off top at the end, right? Because it's a monetary metal and the response to what makes commodity moves is often monetary stimulus. So gold leads at the end. But in the middle of that cycle, and I think we've just entered the middle of that cycle now, other things tend to lead. And historically, that includes copper, and it includes oil, by the way. But typically, copper will lead, since we're talking about copper. Copper will be one of the leaders in the middle of that cycle, outperforming gold. So I am in no way a bear on gold. I am in no way cautious on, well, I'm not, always cautious, but I'm in no way bearish on gold. But I do think for people that bought gold 2 or 3 years ago and now overweight gold, wouldn't be a bad time to bring the gold exposure down to something that's more appropriate for the individual, and move into copper and oil, incidentally. I think the fundamentals for copper are extraordinary. And one of the things about copper that we've mentioned before, but I think it's really important people realize, is that the supply picture for copper is very, very clear 3-5 years out. It takes 5 years after a board of directors gives approval to a project. It takes 5 years before we're producing anything. And so people who spend all their time sharpening their pencils on this, we have a very, very clear picture of what the production 5 years from now not will be, but could be, can be. And there are disappointments always on the downside, as very, very rarely do you get production exceeding expectations. So not very rarely, but rarely. More common is the reverse. So the point I'm making is that we know what production will be 5 years from now, and we simply don't have enough copper. We simply don't have enough copper to meet the demand expectations. It's a higher price.
Thank you very much. By the way, the most analysts would agree with that projection that the deficit for copper will get higher unless something happens with the supply. Thank you so much, Adrian. Appreciate your thoughts, and I appreciate you coming on today. I know you're very busy this week with the prices moving. Where can we follow you?
Yeah, adrianday.com is the best place.
Okay.
That'll take you to my money management, which has a lot of interviews, not as good as yours, of course. And then, yeah.
I wouldn't say that. I encourage everyone to check out Adrian's work. I'll put it in the links down below. Thank you so much, Adrian. Take care for now.
Thank you very much, David. Thank you.
And please do subscribe and like this video. Thank you for watching.